Hi there, in today's video we will learn about what is IAS 36 impairment of asset. Impairment means reduction of asset or liability higher than anticipated. If carrying value is more than fair value, in the case asset is overvalued and profit is undervalued. Profit is undervalued means we are charging more depreciation. Simple rule for impairment, we can understand impairment by looking at this two value. First one is carrying value of the asset, second is recoverable amount. If recoverable amount is more than carrying amount, then it will call as revaluation. If carrying amount is more than recoverable amount, then it will call as impairment. So what is recoverable amount? Recoverable amount is higher of value in use or fair value less cost to sell, also called cost of disposal. So value in use is the present value of expected net future cash flow, means all the net future cash flow which company is expected to generate. So we will convert that entire cash flow at present value. That amount will be compared with fair value of the asset less cost to sell if there is any. So the higher of these two value will be called as a recoverable amount. So we will compare recoverable amount with the carrying amount. If the carrying amount is more, then there is impairment, okay, because the asset is not able to generate the value which it is carrying right now. So with the impairment we decrease the asset value. So that is the simple meaning of the impairment. If the recoverable amount is more than carrying amount, it means that asset is undervalued right now. So we need to revalue. Revaluation is possible when we select that revaluation model. Right now we need to know about how impairment is recognized and how impairment is covered under IAS 36. So here, if carrying value is less than recoverable amount, it is called as revaluation, and revaluation is always gain. It is come in OCI. So in revaluation gain we charge to OCI, other comprehensive income. Reversal of impairment. This is very important topic. What is reversal of impairment? Reversal of impairment is allowed for till extent of the carrying value of the asset without impairment after depreciation. If there is no impairment, rest of the amount will ignore. So this is little difficult to understand at once. When we will study step by step, then we will able to understand what is reversal of impairment. Before going to reversal of impairment, I want to explain one thing. If there is impairment before and after that carrying value is increased more than its original carrying value, fair value is increased more than its original carrying value. So in this scenario we can reverse our impairment till extent that is the original carrying value of the asset without any impairment and after deducting the depreciation. So this is still little tricky. We can understand by looking at the example. For example, carrying value of the asset is 1000. Okay, so carrying value of the asset is 1000 at initial. Now there is two possibilities. First one is after when we have carrying value at initial at 1000, first possibility is we can have revaluation. Second possibility is we can have impairment. Okay, so impairment can be calculated by using the by finding the difference between carrying amount and recoverable amount. Okay, we have seen before what is recoverable amount and also revaluation is calculated difference between carrying amount and recoverable amount. If carrying amount is more than recoverable amount, then it is impairment. If recoverable amount is more than carrying amount, then it is revaluation. So carrying amount is 1000. Sorry, yeah, we have already written carrying amount is 1000. Now recoverable amount is 900. So I'm moving fast forward. I didn't wrote what is fair value in use and fair value less cost to sell, because as I am assuming that you know all these things. So recoverable amount is 900 and at initial carrying value is 1000. So here at first time we have impairment. Impairment of 100. Now this one is the first time impairment we have. Second time recoverable amount is 1200. So first time means we can assume first year, and second time we can assume second year, but it is not about the years, it is about that when there is an indicator of impairment or not. So it can be 4 or 5 time in a single year, and it can be like 1 time in subsequent year, or 2-3 times in after giving 2-3 years gap. So it depends upon that how like your asset will be performed and how the market value will change. So second time recoverable amount is 1200. Now that question arises, can we reverse our impairment? And if we can reverse, then how much impairment we can reverse, and can we perform reversal of impairment with revaluation or not? So the answer is yes, we can reverse our impairment, but till extent than original carrying value. Means that we can reverse our impairment till extent 1000. We cannot reverse our impairment till 1200. So when we will reverse till 1200, then it means we are reversing our impairment of 100, and that will goes to P&L, and 200 will goes to OCI, because it will be called as a revaluation gain. So this is the one scenario. In first scenario, what we have, the first time after initial recognition, first time we have impairment, and second time we have revaluation. So revaluation means recoverable amount is increased. So what we have done, like we can reverse our impairment till 100 only, rest of the amount will be ignored. So this is the scenario 1. And in scenario 2, let's change the value first. Yeah, So second time what we have, in second scenario what we have, recoverable amount is 1300. So what does it means? It means that 300 will goes to revaluation. So now that current carrying value will be 1300. And second time we have recoverable amount, that is 900. So it means that we have impairment. How much impairment we have? The impairment value will be impairment equal 400, because the carrying value at the end of year 1, carrying value at the this is not year 1, just I am assuming carrying value after first impairment, first revaluation. So you can summarize by as a year or as anything, like as you feel comfortable. So for your understanding, I am writing here year 1, that is 1300. So now that recoverable amount is changed, that is 900. So difference between 900 and 1300 is 400 impairment. Now the third time, okay, so carrying value at the end of year 2, yeah, third time no. So third time recoverable amount is 1500. So what we will do in this example, in this scenario, so when we will have the situation like this, recoverable amount is 1500 here. Before that, what we have, we had 900 recoverable amount. So it means that we recognize the impairment carrying a value at the year and the end of year 2, means second time will be 900 only. So but now the recoverable amount is increased to 1500. Okay, so in this scenario what we will do, that first we will reverse our impairment. So how much impairment we have recognized before? We have recognized the impairment of 400. So what we will do, that we will reverse the impairment. So carrying value will increased by 400. The current carrying value will be 1300. So we have recognized the impairment of 400 before, so we can increase our carrying value till maximum 1300. Rest of the 200 will be ignored, because at first time we have revaluation, that revaluation value was 300, and after the revaluation our carrying value will be carrying value had 1300. So we can reverse our impairment till maximum, that we didn't have any impairment before. For example, at first time we took that revaluation, again second time we took the revaluation of 200, so total revaluation will be 1500. So in this scenario we can reverse our impairment till maximum 1500. Sorry, we can reverse our carrying value till maximum 1500, but here our carrying value can be reversed till maximum 1300, because we have recognized 1300 before any impairment. So this is the scenario for IAS 16 property, plant and equipment. If we are reversing the impairment of IAS 38 in non-current intangible asset, in that scenario there is one more thing we have to look at, that is if there is active market or not. If there is an active market for the asset, that time only we can recognize the revaluation. If there is no active market, then we cannot recognize the revaluation. So now let's move forward. IAS 36 apply to all assets except IAS 2 inventory, asset recognized according with IFRS 15, IAS 12 deferred tax asset, IFRS 9 financial instrument, IAS 19 assets arising from employee benefit, and same with IAS 40 investment property that measure at fair value, biological asset which covered under IAS 41, and non-current asset classified as held for sale, that is your IFRS 5, I guess. Now note, if impairment will be recorded if there is any indicator of potential impairment loss. So if there is any potential indicator of impairment, then we will recognize the impairment loss. Impairment happen mostly in the technological sector companies because technology is keep changing. Indicator of impairment, there are two types of indicator. First one is external indicator, second one is internal indicator, including incompatibility, security doubt, and potential obsolescence. Example of internal source impairment: evidence of physical damage or available obsolescence. So if there is any physical damage or obsolescence we have in our internal management, or internal means within the company, so we will recognize the impairment. Annual testing, irrespective of any indication of impairment, the following asset must be tested annually for impairment: intangible asset with an indefinite useful life, intangible asset that are not yet available for use, and goodwill acquired in business combination. These are the three which must have tested each year irrespective of indicator. The impairment test for these assets may be performed at any time during an annual period, provided they are performed at the same time every year. When to test CGU for impairment? So CGUs are a small unit of a small cash generating unit, as all you know. Test an asset for CGU if there are indicator of impairment. If goodwill or intangible with indefinite life exist, test at least annually at the CGU level to which goodwill is allocated. So we will test the impairment of the goodwill at that amount which we have allocated for the CGU. So each individual CGUs will test their impairment of their goodwill portion only, not entire company's goodwill portion. So they will calculate the impairment of entire company's goodwill portion, and they will allocate proportionally according to their goodwill amount. Carrying amount of the test: carrying amount of the CGUs equal carrying amount of the all asset included in the CGU plus any goodwill allocated to that CGU, and plus any allocated portion of corporate share asset. So as we know that corporate share assets are distributed among all the CGUs because corporate cannot generate the cash. So non-cash generating unit, they can't recognize the impairment. Allocation of corporate shared asset. Corporate asset example: head office branding normally do not generate separate cash inflow and cannot be tested separately unless planned to be sold. So when those assets are planned to be sold, that time we will check the value of recoverable amount. So at that time we can recognize that. If a CGU is tested for impairment, you must allocate an appropriate and reasonable portion of the corporate share asset to that CGU if those corporate assets benefit the CGU. So it is about the proportionate basis. Allocate must be reasonable, consist and supportable. Example: allocation basis revenue, head count, floor area. So for example, there are 4 or 5 CGUs, and one CGUs are generating high amount of revenue. So according to revenue proportionate wise, they can spread all the asset. They can allocate all the asset among all the CGUs, and as well as their impairment. So it's about proportion. We do not need to go that much in depth. So now let's move forward to the next point. If allocation is not possible or reasonable, test at a higher aggregation level but not larger than an IFRS 18 operating segment. Yeah. Goodwill allocation rule. Only goodwill arising in a business combination is recognized. Internally generated goodwill is not recognized. Arising in a business combination means purchased goodwill. Allocate purchase goodwill to the small CGUs on a group CGUs is that represent the lowest level at which management monitor goodwill, and it is not larger than operating segment as defined by IFRS 18. So the lowest value will be taken of the goodwill. If you cannot allocate immediately, complete allocation by the end of the next financial year. So if cannot allocate immediately, then we have one more year, so no need to worry about that. It is not much important. Following the acquisition, impairment loss measurement and allocation with a CGU. If a recoverable amount is less than carrying amount, recognize an impairment. Carrying amount minus recoverable amount. So impairment loss, we have same formula. So that is the amount which we derive from this formula. Allocation order of an impairment loss for the CGU. First, reduce the carrying amount of goodwill, allocate to the CGU to 0. Then allocate the remaining loss pro rata to the other asset of the CGUs on the basis of the carrying amount. So first we will reduce that goodwill allocated to the CGUs to 0, then allocated the remaining loss of the pro rata basis. Do not reduce an asset below the highest of its fair value less cost to sell determinable, and it is value in use determinable and 0. So this is the maximum limit. We cannot reduce that below the higher of this. Treatment for revalued asset. It is just obvious that revaluation is performed when the recoverable amount is when the recoverable amount is less than carrying amount. So it is obvious that the highest point is given there. Treatment for the revalued asset. If an asset in the CGU is carried at a revalued amount and the impairment is tested as a revaluation decrease, reduce any revaluation surplus in OCI for that asset first to nil before charge to P&L. What is that? Treatment for revalued asset. If an asset in the CGU is carried at the revalued amount, if it is carried at revalued amount and impairment is treated as a revaluation decrease, reduce any revaluation surplus in OCI for that asset first to nil before before charging to P&L. I think I didn't explain that point, how it will be recognized. Okay. Not here. Okay, let's take example here. Initial carrying value is 1000. Now that first time revaluation of first time revaluation of suppose that 300. Second time impairment of 400. So what does it means? That after first time end of first time carrying amount is 1300. End of second time carrying amount is 900. So the meaning of this point is, first we have revaluation, so asset value is increased to 1300. Then we have impairment. So what will we do? What we will do that when we have impairment, so we recognized in OCI. So in the OCI we have a revaluation surplus. So when we recognize revaluation in OCI, it created surplus. So in the revaluation surplus we have amount of 300. And if there is any impairment, if impairment is charged to P&L. But if we have a OCI revaluation surplus before, so first we will deduct that impairment loss from the OCI, then we will charge to P&L. So here that we have a revaluation surplus, revaluation 300. So now this is the meaning of the point. We have first we have a revaluation. So what happens? So revaluation surplus is created, the amount of 300. After that we have impairment of 400. How we have treated this? First 300 will be deducted from the OCI, and second remaining 100 will be deducted from P&L. This is the normal concept of treatment. So if you have any surplus before, so entire impairment will charge to surplus, and when the surplus value will be 0, after that the remaining impairment will be charged to P&L. If there is no revaluation surplus, then entire impairment will charge to P&L. Let's remove this example here. Let's move forward. Now CGU B cash flow. Year 1 we have 80. This is the example. Year 2 we have 70. Year 3 we have 60. Terminal value we have 50. So what we will do that we will take the present value of the all cash flow. So year 1 we have 80, year 2 70, year 3 60, and year and also in at year 3rd we have a terminal value, that is 50 disposable value. So we have converted this at present value. That figure will be 72.73, 57.85 and 45.08 and 37.57. So we will add all the amount. That amount will be 213.22 USD. Now that fair value less cost of disposal given 320. So here we have we need to find the recoverable amount. So recoverable amount is the higher of both. So higher is 320. So 320 is the higher of fair value less cost to sell and present value of the cash flow. So compare with the carrying amount equal 390. So 390 we have a carrying amount of the asset and recoverable amount is 320. So impairment will be recognized as 70. So this example so this one example I made before, it is little bit complicated because that one include this value in use, present value of expected net future cash flow, and fair value less cost of disposal. So I have calculated all the values before, but for understanding in the simple way I made the example, that simple example before. Now step 2, here impairment is recognized as 70. Step 2 is allocate the impairment when CGO order goodwill first. CGO B has goodwill 120. So before we have goodwill 120, allocate impairment. So first impairment will be allocated to goodwill. So first apply to goodwill value will become 70. 120 and less 70. So goodwill value become 50. So no remaining impairment. So here all impairment is adjusted in goodwill. If now that general entry we need to see, general entry is impairment loss we have recognized 70 and it will charge to goodwill. If when we don't have any goodwill, then entire impairment will charge to assets pro rata basis. Now we will see the example how it will. Example, yeah, impairment we have 100 and there is no goodwill. Now how it will charge to? So general entry will be DR impairment loss of 100, that is simple, and it will charge to P&L in P&L. Now most important, CR we will allocate pro rata basis. How it will be allocated pro rata basis, that's what we have to see now. We have, for example, we have PPE. Total value of PPE is 200, and now we have intangible assets, that the value of intangible assets are 300. Now the how we will allocate pro rata basis. So first CR PPE, and the calculation will be 200 divided by 200 plus 300, total 500, proportionate basis. So the amount we will get, that is the percentage we will get, that is 40%. That 40% multiply by 100 impairment value, the amount we will get, that is 40 is the value of CRPPE. And now CR, intangible asset. Intangible assets. The value of we will do the same thing. The value of intangible assets are 300 and total 500. Proportionate we get 60%, multiply by impairment amount, that is 100. So sorry, 100. We will get the value, that is 60. 60. So DR, sorry, DR impairment, that is 100, and CR PPE 200 divided by 500. First we will derive the proportion of PPE from total asset, and that proportion will be multiplied by impairment amount. So we will get the amount of 40, and here we will do the same process and we will got the 60. So 40 and 60, total will be 100. So 100 CR and 100 DR. So debit 100 impairment loss and credit will be proportionate basis. I just took two example of PPE and intangible asset. If there is anything else, we can take that. So generally there are two. Yeah, so there are so we have took the example of DR impairment loss and CR PPE. PPE we have took PPE value 200 and intangible asset value 300. If there is anything else, like there is any other value, we will took that that value, and we will add both value, and that value will be derived from the percentage. So here we have corporate asset. Corporate asset, if allocation of purpose, if allocation of corporate asset to be as small as CGUs not reasonable, IAS 36 permits testing on higher aggregation of CGUs, but the aggregation cannot exceed IFRS 18 operating segment. If allocation of corporate asset to the smallest CGUs is not reasonable, then IAS 36 permits that we can take higher aggregation, but aggregation cannot exceed IFRS 18 operating segment. We cannot take the entire amount, we can take the operating segment maximum amount. Goodwill, if allocation is not possible at acquisition date, complete it by end of next financial year. If the goodwill is not possible at acquisition date, we have time till next year. It is the topic of acquisition and merger. Consolidation. At the time of acquisition, we find the fair value, and at the time of reporting that, we compare that if there is increase or decrease. Okay, so what happened when there is a we haven't calculated the goodwill yet, because we have time, and the goodwill is calculated at the time of consolidation. When we prepare our consolidation, that time we calculate the goodwill value. So goodwill value is not there, then impairment is recognized on the provisional basis. When goodwill is calculated, then impairment is deducted from the goodwill. Simple. So if there is impairment of 200 and the goodwill is available of 500, so 200 will be deducted from the 500 at the time of reporting date. Simple concept. This is the topic of entire consolidation. I just explained in the short way how it is worked. Now note, if there is no impairment before, revaluation can be applied if the revaluation method is selected. So this is what we have covered before. If revaluation model is selected, IAS 16 PPE is applied. For IAS 38 it can be applied, but there should be active market. Thank you for this video. In next video we will study different topic.